everyone. Welcome to the InvestSMART Bootcamp. It's week 3 of the 4-week course. That's just us trying to frame it around a 4-week learning period. You can take as your own pace to get through it. You've got up to 3 months to get all the content done and dusted and answer those quizzes. And this week looks at module 4, which is investment strategy. So it's definitely one of the more popular topics because it allows us to actually put together some of the stuff we've already learned or spoken about and maybe do some more practical type investing or even research. So my name is Tom Wilson. I'm one of the product specialists at InvestSMART, and I look after the bootcamp as well. So when you do have any questions, you'll probably come through to me. But the other guys that are in the team are more than happy to help as well. So on the right-hand side, you've got the questions area on the GoToWebinar control panel. I definitely recommend you make use of that. This is very interactive, like all our webinars are. So you can ask questions as we go along. And you can add comments as well, ask for clarification on certain things. There's also, when you've registered or registering for the webinars, there's always a little questions box in there as well, where if you can't make it, you can actually pop a question in, register still, and then I'll look at it and try and answer it during the webinar itself. So here's the disclaimer. Obviously, we can't give any kind of personalized or specific financial advice, only general advice. I'll definitely look at the questions as they come through, and if I find that any are, I might either rephrase them or just maybe not answer them, but look at them later and get back to you. And even if I come across a question which is a bit too complex for even me to answer, I'll have a look, get the right person in their response and get back to you as well. So basically, this webinar, the reason we do these is to complement the learning, complement the material that's in the bootcamp already. We don't give any financial advice. We need to stick to the course content. So this week is investment strategies. We'll be looking at that. If there's a question that relates to a previous week or module, or even a future module, I might point you to have a look at that as well, because we do record all of the webinars and put them up on the bootcamp so you can watch them again at your own pace, in your own time. It's also to make sure that you're using the resources, particularly Intelligent Investor and your Eureka Report. They're a gold mine when it comes to what we're trying to get across here. They've got so much educational resources. They talk about value investing in detail, and they even give you examples because the analysts that are on that website are literally doing it for subscribers so they can make their own investment decisions as well. So I'll definitely point you in that direction and show you where to find things and what they will mean. And just remember, this is like an introductory course. It's just going to cover the basics. We're not going to drill down too much into heavy theory or heavy ratios, looking at calculations and things like that. There's a lot of that information that's out there already. This is more of like a primer so that we can do something at least from this first step. So as always, let's just have a quick look at what we've done so far, what we've covered. So week 1's all about the planning. And basically, you want to have a goal. You need to know your time frame. You need to understand your risk profile. So the example I always use is that I'm saving for a house deposit. That's my goal. So my end goal is that I want to have deposit saved up so I can go out and purchase a house. Well, obviously get a loan first, but that's the first step. It's going to take me 3 years, I'd probably estimate, to do this. So if I'm saying to myself, I've got 3 years, or I've only got 3 years, or I'm giving myself 3 years, that's a very important step because straight away I know my time frame. My risk, I'm fairly comfortable with risk. I don't want to go backwards though. I don't want to have, in 3 years' time, have invested in something that was pretty risky. It promised a lot of growth, but it actually has gone backwards. I've got less than what I started with. I don't want that. So I need to understand what kind of investment I could invest in. Then there's obviously diversification, so spreading that risk. I don't want to be like my grandfather and put all of my money into one share or then 2 Australian shares. I want to have it in different baskets. So if there is a problem in one part of the economy or one country or one asset class, then at least that's spreading the risk across all the others. And then in terms of asset allocation, well, what percentages am I putting into each of those different asset classes? I want something diversified, but the percentages, well, for my particular investment or my goal, 3 years is a fairly short time in the investment world. I'd probably want something fairly conservative, so defensive type assets such as fixed interest. I'd still dip my fingers into equities such as international equities or domestic, just to give me a little bit of growth, but I'd be more heavily weighted percentage-wise in defensive type assets. Week 2, we actually went through and looked at all the different types of investment vehicles or things that you can invest in, shares and ETFs that are exchange traded funds. They are very similar because they both trade on exchanges like the ASX. So you can buy and sell them like a share. We looked at managed funds and portfolios, so managed portfolios as well. And then we also looked at cash and basically risk-free type investments or assets. So far, okay, so where do we stand? We know that we need to have a plan. That's one of the most important things that we could ever say is have a plan. And then we need to know what can we actually use in terms of investments to complete that plan. So we've got an idea of what's out there, but then we also have to understand the different costs and risks associated. So last week when we went through shares, we know that it costs us brokerage to buy a share, and then it costs us brokerage to sell a share. So a lot of investors either are not aware of that or they forget about that, and they might find that their profits are heavily reduced from overtrading, so jumping in and out all the time, and that can really weigh down their potential returns. Okay, so investment strategies. We cover off a few in the bootcamp. We try and give you a bit of an idea about what these terms mean, what are some that you could consider taking up yourself, active versus passive, core and satellite. I'll go through these in a bit more detail. If you've got questions though, definitely stop and ask me. More than happy to run through something if it sounds a bit too complex and try and put it into a bit more simple language. So the active versus passive. So passive investing, you're basically choosing to get the return that the market is offering. So in this instance, if you had an index like the Australia 200 index by the S&P, so they are just tracking how the top 200 Aussie shares by capital weighting, as in their size, we're tracking how is that performing each day. So you'll probably hear people like Alan Kohler or other reporters on the news saying the market was up 10% today or it was down 8%, things like that. They're referring to an index usually that's tracking that market. So if we said we just want to get that return, what we're trying to do is follow what shares are made up in that index. And while we can't outperform that, because we can only ever get as good as that return or less because of fees, what we're doing is having an approach that isn't labor intensive, isn't too draining on your fees, and is just following the market generally. Active investing, however, is the flip side, where it's essentially a person or a team who are out there making decisions that are different from the actual index itself. So what they're saying is that they can outperform the market. they can beat it. They will usually charge you a higher fee because of that, because there's a lot more people and time involved. But I guess that's where you need to weigh up what kind of approach you want to take. And as we go through, you'll see there's actually the opportunity to mix and match or have a bit of column A, a bit of column B. The active could also cover off your decision to buy and sell shares yourself. You could have a component of your own investment portfolio where you leave it open, you take recommendations, and you decide to buy certain shares and hold them, or other assets as well. So a good example of passive, the InvestSMART diversified capped fee portfolios. So they're managed portfolios. And you can see I put a photo there of the balanced portfolio. And it's got allocation across a mixture of different asset classes, but fairly balanced. That's passive. So they invest in ETFs that are all tracking their own markets, so giving you exposure to a particular area. There's not someone behind the scenes saying, today we need to buy this, we need to buy that, we need to sell this. It's just a matter of owning those underlying assets, and they track whatever asset class they're in. So it's sort of like a sit back, let it do its thing, and over time, the returns should come through. On the other hand, you've got the active, and I've got an example there of the equity growth portfolio. So this is a managed portfolio as well, which just means that there is someone who is looking after the day-to-day of your account. So you can invest into it, invest into both of these, and it'll be managed for you. But the active means that there's a team of analysts. So Nathan Bell and his team, they're behind the scenes doing all the research, all the recommendations, then the buying of one, the selling of something else to get out of it. And they'll do that day in, day out on a weekly basis. And we can actually even see what makes up the equity growth portfolio, which I might show you as well just in a sec. So we'll jump across to the website just so I can show you what I'm talking about. So you've got Nathan's team at Intelligent Investor, and they've got their portfolios here. So if I click on portfolios, you can see they've got model portfolios on the left. And model portfolios is just examples of their income growth ethical portfolio. So we can actually see what's inside them. On the right-hand side, you've got investment portfolios. So you've got equity income growth, Australian Growth Fund. They're the managed ones. They're the ones where you can choose to invest some of money, and then it'll be looked after for you. The next two are Australian Equity Income Fund, and it's got a little ASX code, INIF, and then Ethical Share Fund, ASX, INES. And those little codes, because it actually trades on an exchange, the ASX in this instance, so you can actually buy and sell them like a share. So let's have a look at the growth portfolio. The best thing about the Intelligent Investor is you've got access to this as a boot camper for a period of 1 month. So definitely take as much use of it as you can. The equity growth. So what they're doing here is actually showing you what a portfolio would look like if you had a growth portfolio. So there's some in cash. Then they've also got their IT sector shares like Audinate, which is quite interesting, right through down to energy and industrials as well. And you can see that they give you a recommendation, separate recommendations, whether speculative buys or holds, and they show the weighting. So what should that make up your portfolio? So they actually give you a percentage on the right-hand side too. We'll probably touch base on this a little bit further, but if you go up to recommendations, they actually have a really good explainer on value investing. And it goes through and tells you what value investing is, but also what their process in terms of research is, and what they mean by buy, sell, hold, spec buy, under review. Plus they explain the pricing guides, the risk ratings as well. And here's the recommendation types there. Just to compare this, if you looked at the InvestSMART portfolios, which are under Invest With Us, if I click on that, this will show you an overview of the diversified capped fee portfolios, and these ones are passive. So if I looked at the balance, let's go learn more. It'll actually show you what they invest in the underlying. So if I go to allocation, this is the allocation I was referring to before, but this is what it's actually holding to get that exposure to those markets or to those areas. These are passive. So you can see that there's companies in here like BetterShares, which is an Australian ETF provider. And there's others like BlackRock. So BlackRock has an ETF, and it's basically tracking the Australia 200. So the top 200 Aussie shares, and it has a ticker code there as well, IOZ. So if you were to go to your own broker, say you use ComSec or NabTrade or someone else, you could actually type in IOZ and see a buy sell price for it, and you could purchase it like a share. What I'll do is I'll just jump back. Actually, I'll quickly show you this really interesting. We're speaking about the Intelligent Investor Growth Portfolio, and they're actually looking to list the Intelligent Investor Growth Fund onto the ASX. So at this stage, register your interest. It's going to be limited to $100 million. So this is an initial offer, which means it's not trading on the ASX yet. But what you can do is, if you think it's appropriate for you, so you definitely need to read the product disclosure statements, the fund fact sheets. And what you could do is you can apply for a minimum of 1,000 units, which at $2.50 a unit is 2,500. So what that means is that when it lists and your application is accepted, you would then own so many units in this growth fund, and then it would trade on market just like a share or an ETF. So you can register now. Definitely read all the information here in terms of its performance, what it's holding. There's going to be a lot of webinars that we're doing behind the scenes. In fact, you've probably seen that I'm doing a webinar tomorrow with Evan Lucas, and it's going to complement this module, which is strategies. So we're going to look at other strategies, in particular around retirement. There's that chase for higher interest or interest type assets that at the moment, unfortunately, they're very low. So we get a lot of questions about that. So you can definitely register for that. You can either go to the very bottom here of the page, or it's in the bootcamp modules already. But if you go to latest events, it's from the bunker, and you can click that. And then the following week, the 4th of September, I'm going to have Nathan Bell from Intelligent Investor come on, and I'm going to ask him questions about the growth fund in terms of why would people put their money into it? Can they do it themselves? How do you choose the shares that go into it? So this is a perfect opportunity for all of us, especially as we're learning about this, to ask him directly, how do you choose the shares that go into it? And I'll touch on that as we go through this webinar too, but it's always better from the horse's mouth. So just remember, you're more than welcome to ask questions as we go through. We're at the core and satellite approach now. So what this just means is, like I was saying before, you could mix the two. So at the heart of it, the core, you can have a passive type investment, and it's basically just going to track the index. So for example, you could have, depending on your goals, timeframes, risk, you could have at the core something like a managed portfolio, like the InvestSMART ones, for example. But then on the satellite, you could have a more active approach. So this is where you're seeking to outperform or even try and beat the market. We call this alpha. And it could be a mixture of different things. It could be managed portfolio by Intelligent Investor. It could be shares that you want to invest in yourself through your own broker. It could be property. A number of different types of assets can fit into that. When it comes to the split, it depends on what suits you. If you had like a 50-50 split, for example, or up to a 70-30, so 70% of your investments are passive, maybe only 30% actively out there in terms of trying to beat, that depends on what you're investing in, but I would say the more core that's passive would be, I guess, a more defensive type approach. But again, it depends on what is in that passive. If you had like a high growth or high risk passive approach, then it may not be the case. So you definitely need to drill down and have a good look at that too. So value investing, it's very interesting. This is what the Intelligent Investor team based their whole picking and choosing of stocks on. And we had a look just before it, the part of their website that explained all the different ratios and earnings and how they choose stocks. There's a question here that Brian submitted just before the webinar, and he's asking, what rules are used to determine whether a stock is a good long-term purchase? Is that a fair price, and to predict the return? It's a great question. I guess all of us are seeking some kind of holy grail or rule book on how to always choose the best stocks that are winners. Nathan Bell, he's written about this quite a bit. In fact, I'll just show you an article that you might have seen this already, and it's on Intelligent Investor. It's a 3-part article, and they've published 1 and 2 so far. And he's talking specifically about the listing of that fund I was just talking about. So I'm just going to click on it here. And he's basically running through about what assumptions people make about value investors, what they are and what they are not. In fact, he wrote a really good piece here summing it all up that I put it into the bootcamp as well. So that should be showing in the value investing section. Otherwise, it should update pretty soon. Basically, we can also go up to recommendations of value investing for a bit more of a rundown. Particularly, you can get links to price earnings ratio, price book ratio, things like that. But to answer Brian's question, basically this approach, you're after shares that they're worth the actual present value of the future cash that they can generate. So that just means that in terms of even opportunity cost, if you could put your money into something now, what's the cost of that going to be in the future? So they use a number of different ratios to try and get an idea of what these values are. So they use price to book value. So they're saying that the share price to the actual assets owned by the company are worth has a few issues where the companies themselves might only show you the cost of what they bought the asset for. They also look at the price to earnings ratio, which is a very popular one as well, and dividend yield. So a lot of the analysts will use this, and you can definitely read a lot more into the specifics of what each one means and how it's calculated. But at the end of the day, what they're trying to do with at least a value investing is to pay less than what the company is worth. So they will use these ratios to try and give a value and then try and determine, is the price that we see on the market, is that less than what the actual value is? The problem with this though is that you get a lot of this information from the company itself, from the company accounts. And those accounts are usually just snapshots in time, so usually around reporting periods. The value investors, so Intelligent Investor, they do have a list of different things they look out for. One is if you've got someone who owns the company, or someone who's, I guess, started the company and they've invested heavily themselves. That's an owner-operated type approach. So if you can see a company that's doing that, that's a good sign where the owner is that confident of his own company. He's put a lot more into it. And there's a couple of tools that we've got, which I can quickly show you too, which are really, I just find these very interesting, but obviously you can use these as get a better idea. So stock screens, this is on the Intelligent Investor website. If I go down to director interests, I can either search by security code, but what this is doing is showing us any kind of buys or sells by directors of companies. So they're legally required to report these to the ASX. And if you were to see, I mean, we can see here, there's the 26th of August. So that's only yesterday. So Net Wealth Group, there seems to be a lot of directors here selling indirect shares. So we could look into this a bit further, like obviously try and work out why, but it's just a good way to get this on your screen. And obviously looking at company reports, you can also see which owners or directors or CEOs are investing into their company and how many they hold, how many shares. So that's one rule, I guess, that they use quite heavily at Intelligent Investor. They're also looking at things like future free cash flow, which is basically after all the bills are paid, all their outgoings, all the expenses, how much they actually have to grow the company in terms of retained earnings, so they can reinvest, do research, and then grow. You also want to look at competitive advantages, and this is where having a team of analysts at the Intelligent Investor is quite beneficial. So you've got a team of all these guys and girls here. I say girls, and yet there's no girls in the team. So all the guys, and what they're doing behind the scenes, they're all following every little bit they can and researching any announcements, any kind of documentation, interviewing, finding out as much as they can about the company, and it pays off. Let's have a look. So I'm going to go back to that listing part 1, and Nathan actually runs through some of the shares that they hold and their reasons for buying them as well. Audinate is a great example. They're talking about how they first recommended it on the 14th of March, and you can actually click on it and it will take you to that recommendation. All the recommendations are audited as well. So it talks briefly about what they do. He says, we invest a good deal of our research resources into analysing a stock's competitive advantage. Less competition leads to more predictable and durable profitability, allowing for sustained price increases over long periods. So he's basically saying that it's a small company still, growth is slow because of COVID, but it's already obliterated the competition, which is a great sign. You can see that they've done a capital raising as well. So this is really handy if you're not too sure what things like that mean. You've got a team of analysts that are in behind the scenes and going through and explaining that it's a good thing because of this, or it's a bad thing as well. And you can see that it's a spec buy when they were talking about the capital raising, so at $5.69. So more than double when they first recommended it. And it looks like it's because of that capital raising, it's going to be investing heavily to increase its competitive lead. So they're talking here now, though, it looks expensive on traditional metrics. So probably those metrics we're talking about before, those ratios, but now it's got capital, which means it can invest that and grow the company just around the time when the whole economy is, fingers crossed, recovering as well. Valued at $400 million, but they reckon it'll turn into a multi-billion-dollar business. And the thing is that they'll keep you up to date as they go through. So I believe that we even had some latest. And if I can't find it on here, I can always just search for it as well. But here we go. Yeah, so just on the 21st, they provided an updated recommendation. So I find this very handy myself. I'm constantly looking at it because I find it so interesting just seeing their take on it all. But I guess to sum it up, Brian, that would be the kind of rules that you would look at in terms of a value investing approach. You would obviously want to make sure that any kind of share you're going to invest in is liquid. So there's enough of it, there's enough that you can buy. And if you had to sell to get out of it in a hurry, there's enough, I guess, demand for it that you could do that. There's nothing worse. And I used to work at a broker where we'd get some clients ring up and they had positions in really illiquid small companies. And they would say, I need you to sell $500,000 worth of this stock. And I want it done by the end of today. And unfortunately, because there weren't too many people wanting to buy it, it was very illiquid. The market wasn't there, and you had to usually discount it heavily to get the order filled, which is not good for them because they often left with a few losses and frowns. So that was value investing. I'll just double check to make sure there's no questions that have popped up yet. There hasn't, but that's fine. If you do see something where you want more info, just yell out, put the question in the side there, and I'm happy to answer it and go through it for you. Technical analysis is another way that you can try and work out an investment, whether it has value or what it might do, try and predict the future movement. You're basically looking at the price of that asset or instrument on a chart. So it's a great way to see a long-term trend, whether it is actually going up in value. The problems are, though, that as human beings, we have a tendency to seek out patterns in everything we see. So even when we look at clouds, we might see a face or a figure or Jesus or something like that. So that does play on us, unfortunately. When I was at the previous broker I was talking about, a lot of people had solely their investment strategies based on technical analysis, and some of them worked quite well, but only for periods of time, as it was quite cyclical. So when the market was a bull market, constantly going up, they would have a certain strategy that did well, and then when it would change, suddenly they'd be left high and dry, and they'd have to try and change their strategy on the fly, which is fine. Some of them had numerous strategies up their sleeve, which they could chop and change as they went. The biggest thing I'd say with this is just be careful. A lot of this can be speculative and usually around instruments that are fast moving or even leveraged. And there's a lot of traders out there who sell their technical analysis through the form of bots, or they might have some kind of investment program themselves. They do deserve more investigation in terms of asking them questions. A lot of them are cyclical. Some of them are scams. So just be very careful with that. But instead of just talking about it, I'll show you what I'm talking about here. So there's a great company I find really interesting called tradingview.com. I can put a link to it in the course content and even after this as well. But what it does is it's free. You can upgrade to get rid of the ads, and you can upgrade to get more features, but you can type in a ticker code and it will allow you to do some technical analysis. I'll show you an example. So this is spot gold. And in the From the Bunker webinar last week, Evan and I spoke about spot gold and the perils of investing in it, and the fact that spot gold is actually, it trades like FX, so foreign currency, foreign exchange. It can be quite erratic, volatile. But there's a lot of interest at the moment. As you can see here, it's up to 1,952 US dollars. So it's sort of getting up to that all-time high. Now, what technical analysis is, there's so many different things that you can draw on a chart to try and predict future value. And you'll probably see some scary stuff. Like if I click on the left here, well, that's not scary, that part, but let's get them up there. You can see all these different, I guess, symbols or drawings like pitchforks, Gann box, Fibonacci. Fibonacci is quite popular. You might have heard of the Fibonacci, the naturally occurring sequence, and people will use that to try and predict. The straightforward way is just drawing trend lines. And what I mean by that is if you were to take, say, one of the lowest lows here, if I click on it, and then I find maybe the next lowest low of a candle here. So what this chart is showing me that each candle, so each little candle like looking here, and they call it because it has like a body and a wick, and that's representing the high and low of that period, but then also where it opened and closed. Each one of these candles, I've chosen to make it 1 month. So it's showing you 1 month of price of spot gold. I could change it at the top here, but I find that technical analysis works best when you do take a longer term overview. You step out and then you can drill down as you go. But here's just a basic example. In fact, I probably should have put that first point maybe on one of these lower ones here, so I can just do that anyway. That would be more correct. So this would be what we call a support line. And you can see how I put it at the low at the start here, and it's hit it once. You'd say twice there. And usually they say twice is a good confirmation. And then on the third as well, and then the fourth. And then you can see from the fourth here, it's taken off. Now, the problem with this is there's obviously a number of events that have occurred, such as the COVID pandemic, that have probably or likely increased this dramatic rise in price. But one of the best things I love about this trading view, just for a bit of fun, is that you can actually go back in the past. And what you can do, I'll just see if I can get that up. There's a feature here that allows us to actually step back in time and watch. Here we go. So if I was to choose this point, we can go back, and based on the line that we've drawn, so hit it once, hit it twice, that would be enough to draw a line. So we've come up to here, which is 1st of December 2015. If you were someone who's taking a very long-term view, you've got this drawn already, you could say to yourself, okay, that's a fairly strong line here, support line. If it was to break through, I could think about putting some kind of sell order here, because there's a good chance that if it did break through this strong support line, it would keep going down. But there's also the view that if it hits it here and bounces off it, I could put a buy order somewhere up here, and that would be further confirmation that this support line is solid, therefore it should just keep going up. Now, I'm sort of giving you this as a bit of just an overview in the sense that this is what people do think, or the technical analysts think this kind of way. I find this interesting, but I don't think it's something that you should base your investments off. I think that it is pattern seeking, and there's a lot more fundamental analysis that we were talking about with value investing that would be a lot more realistic. But just to, I guess, give you an idea of how it works. So if I was to press play, we can now walk through and watch what did happen. And obviously, benefit of hindsight, always remember that. So it might be a bit slow, so I'll just see if I can speed it up a bit. But basically what it will do for you here is each one of these is a month, remember? So it's going to chart. So if we had said, okay, if it does bounce off this line again, we put a buy, you could have had a buy here, so it would have triggered. You would have seen it probably go back and forth, like that would be running at a loss, which is, a lot of people don't realize that that's scary when you see your position in a loss. But over time, you would have seen it go through and eventually rise up to where it is now. But how you get out of it is a whole different kettle of fish, whether or not you have a signal to sell. But this is just an example of technical analysis. I'll put the link on there so you can have a fool around with it. But again, just to reiterate, it is fairly pattern seeking. It usually involves leveraged or volatile assets like gold. So just be very careful. we prefer the long-term approach at InvestSMART and Bootcamp in terms of diversified. You're in assets that are not too volatile, and if they are at least spread across different asset classes as well. And it's in line with your goals. Like, I used to often ask a lot of traders at my old job, what is your goal? And a lot of them would just say, oh, to get rich. And that's obviously all our goal ultimately, but they had no real plan to get there. And even using technical analysis, I would concede, was not the best way to do it. So that's the website. There's a link there as well. I believe it will take you to a certain kind of chart, but I'll post that up later as well. So when we look at income, we're basically looking at dividends, interest income, other in terms of tolls, so if you purchased a company that owns a toll road, you'll actually receive the tolls as income paid to you. Interest income is obviously from fixed income or hybrid type assets. Dividends are paid from the company themselves. Basically, you're owner of the company and it's paying you a share of any kind of income that they've received. How you view income, it depends on what stage of life you're in. So for example, we have a lot of clients who have a very long-term horizon or time frame. They might be in their 30s and they may not want to, they may be invested for just growing their wealth. So they would be best suited to have their dividend or interest or income received reinvested back into their investment so that it grows. They get the benefit of that capital compounding. However, if you're in a later stage of your, say, retirement phase, it might make sense that you view income as a way to supplement your lifestyle. So you may choose to have it paid out to you on a monthly basis instead. And you can do that with the InvestSMART managed portfolios. You have that option to have it paid out to you or just have it reinvested automatically. So bucket strategy is another approach, and it basically involves keeping or having three buckets, hypothetical buckets. And that first bucket there is keeping cash on hand for the current living expenses just over the next 2 or 3 years. Then in your second bucket, you're going to have additional income, so from dividends or interest, and that's from holding like a diversified portfolio. A balanced one is written there, but obviously it depends on what stage you're in terms of your investment journey. That third bucket is more of the growth portfolio. So that's sort of like dipping your toes into assets which are going to give you capital gains. And again, it's recommended diversified as well. And they say growth there just as an example. So you can see though, from bucket growth, it tops up the cash flow bucket. And then we're putting our income into the current spending bucket. There's a question here from Kerry, and it's, do you recommend any simple investment management programs where you can easily track the balance or movement of your buckets? There's the portfolio manager, sorry. So InvestSMART has a portfolio manager at the top here, which is My Portfolio. I'll click on it and I'll just show you. This is a free way to show you what you're holding, and you can track nearly any asset in here, including property, any kind of portfolios, any kind of shares. This is an example. It's a test portfolio. So at the start of the year, my colleagues and I, we have a competition where we have to invest $1,000 into each letter of the alphabet on the ASX. So A could be ordinate, for example. And so obviously we started with $26,000. It obviously dipped during the year because of the pandemic, but currently it looks like it's in positive growth, which is quite interesting. And again, this is an interesting strategy. Like, this is just me putting $1,000 into shares that start with the letter of the alphabet, each one. There is a an ETF, and I can't remember the name of it out there, that actually does something similar to this. I believe it's a Better Shares product, but you can always say Eureka Report, you can go filtered tools and go exchange traded funds and look up all the different ETFs as well. But this could be one way, Kerry. There are other portfolio management systems that are on the market. I think the others do charge fees, but you might find that it's a lot more automatic. These will track the movement of your assets. Some of it's manual, so you have to update. Say if you've got property, you'll have to update the price if there's a revaluation in there. It will recognize dividends, but this is one way that you could do this to manage your bucket strategy or your investment program. So we talk about market timing, and this is one of the things that as human beings, unfortunately, we're quite bad at. And I've seen this firsthand, and you may have as well, unfortunately. Being on the investment side of things, having a lot of clients ring up and trying to work out when is the best time to get in and out of a market, such as when we had the pandemic back in March. We had a few clients who would ring up and said, everything's going to be terrible, I need to get out of my investment. And they might have been invested in a high growth model where it sort of does say you need to be in there for 5, 7+ years because of movements in the market like this. And it is scary seeing your investment drop below a certain level or even go backwards. It's not a good thing. However, the biggest problem we've got is if you do go ahead and take out those funds, which you're totally allowed to, it's well within your rights. And if it makes you feel better about it, then it's difficult to argue with. The problem is, and I would always say this to the clients who did this, are you going to put it back in? And they would say, yeah, definitely. I want to put it back in because I want to continue to invest and grow my wealth. And I would ask, well, when are you going to do this? And they said, oh, when everything returns to normal. And the next question is, well, how do you know when it returns to normal? Like, what is your sign that it does? And it would often be when the price recovers. So the problem there is that they would be getting out usually around the bottom, because you can't pick where the bottom is, or maybe even before the bottom, but they would get close to the bottom. So they get a really bad price and they would crystallize that loss. And then it would recover. So it would go back up to where they had gotten out, but then they would wait a bit more because they want to make sure then it would go above where they had gotten out. And then they decide to reinvest. So in between that period, they've lost a chunk of wealth, of their own money, of their investment. And it's basically because of us as humans. We don't like to see that we're losing. We don't like the idea that we could be wrong. We have great plans in place in terms of we have a plan, or we should have a plan when we start this. And it does come back to that. What are your goals? If your goal is a 7-year time frame, why aren't you sticking to it? So you do need to have a strong plan. You need to understand how you can mitigate this as well. So we look at things like dollar cost averaging, where we had a lot of clients who actually did the reverse. They said, this is a great opportunity to buy. I want to get in. It's a bit volatile. The price is up one day, down the next. What's the best way to do it? We said dollar cost averaging. So someone who might have $200,000 that they wanted to invest through their self-managed super fund, we would say to them, okay, you don't have to put it all in at once, one big chunk, because that will immediately expose you to those wild swings. You could break it up and do $20,000 over a period of 10 periods. So you could have either 10 weeks, or you could have 10 days, or every fortnight, and do it that way. And what it's doing is each time you put it in, it's giving you an entry price, but as you go, it's averaging out that entry price. So you might have a day that is down, so you can put that in, you get a really good price, but the next day might be up. And if you continually have days like that of volatile periods, then eventually it will smooth out. But the biggest thing that we find is just knowing that you've got a plan, you know your time frame, and you also understand the risk that you're comfortable with. So if I was looking to put my money, so I can save it for my house deposit, and I put it into a high growth, I know that that's high risk. And each time there's a movement in the market, which there always is, I know that I probably wouldn't be able to sleep properly. So straight away, it's a red flag. I wouldn't want to invest just based on that alone in such a high risk product. It's quite a interesting module, this one. There's so many different ways to go about investing into markets. Basically, it comes back down to, we always have the approach to like keep it as simple as possible. If you can invest in something like a diversified fund that's managed for you, that's a great start. But just always be aware of the fees. We have a lot of tools on our website where you can compare different funds that give you that kind of investment exposure. We offer our own, of course. I sort of talk about these because I know about them, because I'm quite heavily across them. I don't know about all the other funds that are out there, but one thing that we do is that we cap our fees. So it's like an industry first. That allows most of that money to stay back in your pocket so it grows. Definitely join us tomorrow. We're going to have a really interesting session with Evan Lucas, who's the Chief Market Strategist of InvestSMART. And this is a great opportunity to throw questions at him about investment strategies, particularly around retirement, because he's going to delve more into that, I guess, search for higher interest or interest type assets in that retirement phase. So thank you again so much for joining. And if you've got any questions about Bootcamp, or if you're struggling with something, or you wanted more elaboration on a topic, or just even feedback, let me know. You can send an email, bootcamp@investsmart.com.au. And there's also on the website, you've probably seen there's a little icon at the bottom right for a live chat. That's staffed by real humans, including myself, from 9 a.m. to 5 p.m. Melbourne, Sydney time, Monday, Friday. So you can definitely ask us questions there. But until next time, thank you for joining us.